Yesterday sold off and reversed up, and it reversed up a lot. So you have big down, big up. That usually leads to confusion in a trading range. Yesterday we had a big bear breakout, a spike down, a bounce, and then a channel. So it's a spike and channel pattern. The market typically tries to get to the start of the channel, which it did, and then evolves into a trading range. So that's another reason to expect a trading range. And then on the daily chart, we've been sideways now. Today's the 7th day, and yesterday ended in the middle of the day's range. So 7-day type trading range. That's another reason to expect today to be sideways again. Bears hope this is a double top, this high, that high, and they want to break up below the neckline and a measure move down. What we might be doing is forming a triangle. Here's a 15-minute chart. We have a high, we have a low, we have a lower high. Maybe we'll get a higher low and go sideways a little bit more. Any trading range in a bull trend is slightly more likely to have a bull breakout than a bear breakout. But the more bars you have in the trading range, the more the market becomes 50-50. So this is, close to 50-50, but it's still slightly more bullish than bearish. So it's more likely we'll go up here before we go down here. Again, this is a 15-minute chart. Back to the 5-minute chart. What do you do right here? Do you buy above 81? Nope. Pretty good sell-off. A lot of the bulls will want a micro double bottom. Yesterday, the 60-minute moving average, we had a sell climax. Probably we'll get a second leg sideways to down, and we got it. And then we had another reversal with an even better buy signal bar. Possible low of the day, but it failed at the moving average. It failed at the moving average again, forming a double top here, broke below the neckline, fell for about a measured move, and then reversed up again. On the open yesterday, we had a wedge, different ways to draw it, 1, 2, 3, or 1, 2, 3, at the moving average after a gap up. That's a reasonable buy setup. We had a big bull bar closing on its high, but what's wrong with it is we only had a little part of the bull bar below the moving average, and most of the bar was way up here, forcing you to buy high in the tight trading range. So even though it was an outside pattern, outside up again, with the bull bar closing on its high, it's not an ideal buy. And it was a bull trap. On the open, 50% of strong moves are traps. They're a test of support or resistance, and the market reverses. So you look at this and say, oh, wedge bull flagged, pull back to the moving average after a gap up. We have to go up. Great looking bull bar. No, you don't. 50% chance it's a trap. And it's a test of resistance here, the high, and the market will go the other way. We're again testing the open of the year, which is also the open of the week and the open of the month. Bears are hoping. The other chart, we have a micro double top. We reverse down. We're trying to reverse down the second time. Yesterday's a bear bar. It's a sell signal bar, but it has a fairly prominent tail, and it's a very strong bull trend. So there probably will be more buyers than sellers below yesterday's low if we go below yesterday's low. Here's yesterday's low. For the bears, a double top bear flag, a higher high double top. They want to break below the neckline and a measure move down. And the bulls will want a reversal up from an expanding triangle. 1, 2, 3, 4, 5. Because yesterday has a big tail on the bottom and we have a very strong bull trend, there probably will be more buyers than sellers below yesterday's low. What about the wedge? 1, 2, 3. And it's possible that this is going to be a buy climax in the end of the bull trend, but I still think it's more likely we'll go higher. I think this is strong enough so that it might have started the count over again. So instead of 1, 2, 3, it might be 1 and then a new 1, pull back 2, pull back 3. So I still think we're going to go higher. Plus, we have the top of the channel on the daily and weekly chart up there. So I think that's where we're headed. Do you sell below 1? I would not. I would wait to see if we get consecutive bear bars before selling at the low of yesterday's range and at the low of 6-day or now 7-day trading range. On the monthly chart, we have a breakout here and a pullback testing it. So we have a potential measured move up from here to here. Which is around 5,000. But then there's also an attempt at a top here, and then there's a gap on the monthly chart. And it's not so obvious. And therefore, you're going to be thinking that maybe we'll go for a measured move based on that gap, which would take us up closer to 6,000 before this bull trend ends. Also, on the daily chart, well, I'll put up the weekly chart. On the weekly chart, every big round number, 29, 30, 31, 32, 35, 40, 41, 42, every big round number, the market paused on the way up, except for one, 4,000. We broke above 4,000 here with no pause, so that might be a measuring gap. So from here, which is around that gap up on the monthly chart, so that's around 5,800 or so. And on the monthly chart, we have that gap over here. So I think the market might be going there over the next couple of years. Because of the micro wedge here, up, down, up, down, up, probably down in January or February. Because of that, I think we're probably going to pull back for a month or 2 or 3. So sideways to down, maybe to the December low, maybe the October low. But I still think we're going to go higher. Perfect example of what I just said. Any big move on the open, 50% chance it's a trap. It's a test of support or resistance. So here we have a very big bear bar in a bear trend. And now the bulls bought the close, right? I tested the open of the day. The bulls want some kind of a reversal. If we get below yesterday's low and reverse, we have an expanding triangle, 1, 2, and 3. If we reverse here, we have a higher low major trend reversal, head and shoulders bottom, left shoulder, head, right shoulder. But even if we reverse, I still suspect that we're going to form a triangle. As I said, 15-minute chart. I'll put up a 5-minute chart. So big move down, big move up, maybe down, up, and then down again, and then decide on the breakout. Now, I've talked occasionally early in every year. If there's a trend on the open of the year, the market typically comes back and tests the open several months later. And we're testing the open of the year a lot right now. But I think we'll come back here if we rally over the next month or 2 or 3. I suspect that we're going to go up January, February, and reverse down either the end of January or the end of February for a couple of months. Bull's trying to get a reversal here from the open of the year, but so far, a big tail on top. So you look at it, and the bears look at 1, 2, and they say, oh, gosh, I don't want 2 to look like that if I'm bearish. And the bulls look at 2 and say, gosh, has a big tail on top. I don't want it to look like that if I'm bullish, especially after 3 big bear bars and 5 bear bars on the way down. So, and plus we're at 2 moving averages, both of them flat, which means the market's sideways on the 5-minute chart and on the 60-minute chart. And, that's not fun for stop entry traders because they don't want the market reversing. They want it to keep going one way or the other. They don't care which way as long as it trends. But spike pullback channel typically evolves into a trading range. And so this might be the start of a trading range. You could argue this is the start of the trading range. Very often, trading ranges start before trends end. And, I would say this is the start of the trading range. New low, new high, new low, new high, and we're back here again. So I would say this is the start of the trading range, even though the bear trend had not yet ended. There's often a transition. There's usually a transition from bear trend to bull trend or bull trend to bear trend. There's usually a trading range transition. So the market goes down and then it goes down less clearly and starts to go sideways before it goes up. And the opposite is true at a top. The market usually goes up, stops going up, starts to go sideways before it will go down. Well, the bull's a high to 81, a test of yesterday's low and a test of the open of the year, but a big tail on top. And therefore, it's not a particularly good buy. I think it's better to wait. Big bear bar 1, they bought the close. Big bull bar 2, they might sell the 2 high. So it looks like a trading range open. What happens at 3 is a big bull bar closing on its high? Well, I talk about that all the time. If you have on the open consecutive bull bars, one being big and closing on its high, it's a buy the close market. And 2 did not close on its high. But if 3 is a big bull bar and it closes on its high, it would be a credible buy. Big risk, right? The bars are big. So if you trade it, you trade small. And if you cannot trade small enough, you wait. The bears, we have a bear trend since 77. And we broke below the open of the year. We broke below the 60-minute moving average, and we pulled back. For them, 3 is a low 1 sell signal. Now, remember, on the daily chart, we have a small double top, and yesterday's a bear bar, a sell signal bar. So we might have to go below yesterday's low to see if we fall from the double top and begin a trend down. But as I said, it's a 7-day tight trading range on the daily chart, and yesterday's a big tail below. Therefore, if we do go below yesterday's low, there probably will be more buyers than sellers there. So for the bears, we have a double top. Yesterday's low is the neckline. They want the measure move down for 30 points. More likely, there'll be buyers somewhere not far below yesterday's low, and we will reverse up from an expanding triangle. I know you want to trade, right? But you should be looking for stop entry trades and swing trades. And this is not the kind of price action that you should be trading. You should wait. Most days have some kind of a trading range open. Yesterday we had a trading range open here. You could sell below 4, a failed breakout of the prior day's high. Below 6, a low 2 top, a second reversal down from the prior day's high. You could buy above the wedge and the 00 and then sell here, or you wait for a new low below 12 and then sell below that. So sometimes even with the, well, very often, even with the trading range open, there are stop entry trades. Had you shorted below 4 or 6 yesterday, I think it's good to get on above 12. It's not necessarily good to get long above 12 because, as I said, too much of the bar is above the moving average, only a little bit below. That's often a trap. All right, so for the bulls, they have consecutive bull bars, both big, but the bodies are not particularly big, and the bodies do not close on the high. So it's not yet by the close. And for the bears, it's a low 1 and a bear channel, similar to yesterday. Reversal up, low 1. Reversal up, outside down. Reversal up, low 1. A double top bear flag, right? So the bears are hoping that we're channeling down like that. But a big bounce from the low of 2 to the high of 3. That will reduce the number of traders willing to sell at the low. And traders do not like to sell below bull bars, bar 3, and they do not like to sell at support, the open of the year, yesterday's low. So while it's possible one will remain the high of the day, I think it's better to wait. Low 1 in a bear trend that began 77, but 2 bull bars. So not a very good sell. Probably buyers below 3, buyers below 2, and buyers below 54, because yesterday is a bad sell signal bar on the daily chart. Yesterday, we had two reversals down from resistance, a high of the day before, and it began a bear trend. Bulls trying to get two reversals up from support. Open of the year, yesterday's low, 60-minute moving average. But they need a good buy signal bar. Two is not good enough. I think a lot of traders want to see it go below yesterday's low because yesterday is a sell signal bar. And, we want to see, will a lot of traders sell it, or will there be more traders buying it, betting that it's a bad sell, which is what I think. The bulls want a higher low major trend reversal. They have it, bar 2, but big tail, tight bear channel. And now they have a high 2, bar 4, micro double bottom, but it's a bear bar, so probably sellers above 4. And probably buyers below yesterday's low. Best choice, wait. I want to check something. I'm going to turn the screen off for a moment. Head and shoulders bottom, higher or low major trend reversal, bear trend, strong minor reversal, and now a second reversal from a higher low, but bear bar and tails 2 and 3, and just below 2 moving averages. So I would wait. What I wanted to show was this. I put this in today's blog. This is the Euro chart. We've been 7 days sideways. We have a bear channel, spike, and then channel. Here's the top of the channel. We broke strongly below the bottom of the channel. 75% of the time, if the market breaks below a bear channel, the breakout will fail, and the market will try to get to the top of the channel. It can get to the top of the channel by going up or by going sideways. And this is an example of the market going sideways to the top of the channel. The bulls hope that this is a climactic end of the sell-off, and that this is a bottom, a higher low major trend reversal, and that we begin a reversal up. And the bears hope it's a bear flag and a bear trend, and that we go down. I think we're going up. We may go down first, but a tight trading range late in a bear trend is usually a final bear flag. So if we go down, maybe for a measured move down here, I think it'll fail and we will reverse up. So I think we're going up here or here over the next several months, but we may go down here and then up. The market might be waiting to go sideways to the top of the channel and then decide whether to break to the downside and then reverse up, or rather to break above the channel and begin to move up here. So I think this is where we're headed in the next few months, but we may have one last sell-off first. A high 2, higher low major trend reversal, but a bear bar, tight trading range, lots of reversals, trading range open, just below 2 moving averages. So not a lot of buyers above 2, not a lot of buyers above 4. The bears are hoping that we get a low 2, which we have, bar 5, but it's a bull bar, just like the low 1, 3 is a bull bar. So limit order market, sellers above 4, buyers below 5, better to wait. Wait for consecutive bull bars, consecutive bear bars, strong bars, bull bars closing near their highs, bear bars closing near their lows. The market's deciding, are we going to go below yesterday's low? I think we will. We're still always in shorts in 78 or 79. And on the daily chart, yesterday is the sell signal bar. So I think we're going to go below yesterday's low. And also, we're not getting a good bottom, 2, 4, and we're not getting a strong reversal up yet. That could change. 1 or 2 big bull bars closing on their highs, and then this will be the low of the day. Bulls trying to break above the 2 moving averages. They're trying to break above the high of the day, and then they're hoping that we get a trend up. Bears are trying to get below yesterday's low. Whenever you look at the market and you can see, there's a reason to go up, there's a reason to go down, you should assume that the probability up or down is 50%. During the bull bars, it's slightly higher. During the bear bars, it's slightly higher that we'll get a bear breakout, but you should assume it's 50-50. And you should assume the first breakout in either direction will fail. 7 o'clock, there's often a news report or some kind of an announcement, so there's an increased chance of a sharp move on the close of bar 6, on the open of bar 7. What happens if 7 suddenly in the final seconds closes on its low? That would be the first stop entry trade that I would consider today. It would be a low 2, 3 with bar 3, and a lot of failures at the moving average. Up, down, up, down, up, down, up, down. Plus yesterday's low is a magnet below. How big a bear body will the bears want to see to short below 6? The bigger the better, and they'd like the bar to close more on its low. On the other hand, if 6 is a very big bull bar, closing on its high and closing above 1, you'll start to get by the closed bulls. A lot of bulls will wait to see a follow-through bar because they don't want to be trapped like yesterday, 12. Still waiting. Not good buy signal bars, 2, 4, and 6. Not good sell signal bars, 3, 6. Either you can get a good signal bar or a strong breakout. Either one of those things will be enough to make people trade. We have an IOI on the 15-minute chart, but a big tail on the top of the 15-minute bar. For the bulls, we have a higher low, another higher low. We have a triangle. We have 3 lows, 1, 2, 3, and 2 or 3 highs. So breakout mode on the 15-minute Globex chart. 90% chance we're either going above the Globex high or below the Globex low at some point today. High 1, 6, but 4 bars with tails all at the moving average. So not a very good buy, despite the 15-minute bull bar with a good-sized body. Here's the 15-minute E-mini, head and shoulders bottom. Day session, left shoulder head, right shoulder. Bear trend, bull breakout, higher or low, major trend reversal. But tail, pretty conspicuous tail, and 3 bear bars. So I would wait and not buy above that 15-minute bar. Low 2, 6, but 4 of the past 5 bars have bull bodies. So not a good stop entry sell, not a good stop entry buy. A low 2, but 2 bull bars. Bulls hoping it's a small pullback bull trend like yesterday. Down here. Reversal, yet it kept going higher. And bears hope it's a bear flag, bear trend, triangle, low 2. Now, what about selling below 7? It's better than selling below 6, but it's still not all that good. So far, trading range open, and you're selling in the bottom half of the range. Also, the sell signal bar 6 has a bull body. Now, can you buy above 7 or above 5? The bears who sold below 6 might get out above 5 or above 3. Sometimes I will enter on the breakout, but here I will not. What happens if 8 is a bull inside bar closing on its high, closing at or above the moving average? I think traders will start to take that buy, betting that we've begun a small pullback bull trend like yesterday. Small pullback, pause, small pause, small pause. Triangle, we have a series of higher lows and lower highs, breakout mode. Markets deciding, is this a higher low major trend reversal and the low of the day, or is it a bear flag? It's both. We don't know which will be successful, but every trading range has both a credible buy setup and a credible sell setup. The bulls need a bull bar closing on or near its high and close above the moving average, maybe bar 8. And the bears need a sell signal bar that closes near its low, not 6. And 7 is not very good. 6 was the sell signal. And the bears need a sell signal bar that closes near its low, not 6. And 7 is not very good. 6 was the sell signal. Can the bulls get 8 to close on its high? We've got 10 seconds left. Does not look like it. So small pullback bull trend, another high 1. We have a breakout and a pullback, so it's another high 1, just like 4 was a high 1. But tail and top of a triangle, top of a tight trading range, and below the moving average. So that's not a very high probability buy above 8. It's not a very high probability sell below 8. Remember, we're still always in short, so it's still slightly more likely we're going to get the downside breakout. No close above the moving average. We've had 7 bars with highs above the moving average, but no close above the moving average. Slightly more likely we're going to go below yesterday's low, but a bull breakout here, and then this will end up the low of the day. So far, II, okay, so that is an II, it's breakout mode. An II is a triangle on a smaller time frame chart, and this II is at the apex of a triangle on the 5-minute chart. It would have been higher probability for stop entry traders if it closed on the high or low of the bar. So it would have been better for the bulls if 9 closed on its high above the moving average. More bulls would buy above 9. It would have been better for the bears if 9 closed near the low of the bar. More bears would sell below 9. It's still a credible sell below 9. It's a less good buy, but it's really not all that good. Different ways to trade it. One is you sell below 9, put a stop above 5, or a stop above 3, not much higher, and trade small. If it keeps going down, you sell more lower. And for the bulls, I would rather buy above a decent bull bar, so I would still not buy above 9. If we go below 9 and reverse up with a bull bar on 10 or 11, that would be a possible buy. Remember these II patterns, 50% chance the first breakout fails. Now this is different from 52 yesterday. That was an III, but it was late in a bear trend, so it probably was going to be a final bear flag. So if we got a breakout to the downside, you'd expect it to reverse up, which it did. This is in the middle of a trading range, and therefore it's not a final flag. It's just a breakout mode pattern. 50-50 chance if we go up, it'll fail, and then we'll go down. 50-50 chance if we go down, it'll fail, and we'll go up. Again, that's different from yesterday, 52. If we went down, I would say better than a 60% chance we would reverse up within a few bars, which we did. For breakout mode traders, it's a stop sell below 9. Theoretically, it's a stop buy above 9, but it's probably better for the stop buy above the 3-5 double top, because 9 is a bear bar. Or you wait for a bull bar closing above the moving average and then buy above that bull bar. 50-50 chance the breakout up or down will fail. 50-50 chance it'll be the start of a swing. Chance it'll be the start of a swing. Three inside bars, I, and now 10 is a bull bar. So some bulls will buy above 10, but it would have been better if 10 closed at or above the moving average. Risk is not big, right? You buy above 10, stop below, I don't know, 7. Or if you sell below 10, stop above 7. So not a lot of risk, but probability is only 50-50. A lot of traders will wait to see the breakout, or they'll wait for a strong breakout with follow through and then trade. Broke above the 10 high, the III, but we have not closed at the moving average, and most bars today poked above the moving average and closed below. Will this one be different? We'll find out. The bulls need bull bars closing on or near their highs. They need bull bars closing above resistance, the 10 high, the moving average, the 5 high. And the bears want a reversal. So they don't mind 11 being a bull bar if 12 is a bear bar. Right now, we're on the buy above 10. The close of 11 is important. The more bullish it is, the more likely we've begun a swing up. If it ends up as a very big bull bar closing on its high, and then if 12 is also a bull bar, then there's a 60% chance we've begun a swing up. But if it's a bull bar like yesterday, 12, and the next bar is a bear bar closing on its low like yesterday, 13, then this is probably a bull trap, a failed breakout. Okay to be long, all right? Okay to wait to see if we close above the 3 high. Okay to wait for 2 consecutive bull bars, a follow-through bull bar. And for the bears, it's okay to wait to see if we get a bear bar on 12 or 13. The minimum the bulls want is a bull body. Next, they want to close above the moving average, a close above 10. They'd like to get a close above 5. They'd like to get a close above 3. They'd like to get a close above 1, the high of the day. They'd like to get a follow-through bar. The more of those things they get, the more likely we've begun to swing up. The fewer of those things, the more likely the breakout will fail and will go below yesterday's low. All right, so they got some of what they needed. They got a close above the moving average, first time all day, but the close was at the high of 7 and not above it. They're trying to get a breakout above the high of the day, which they just did. They're trying to get consecutive bull bars. They're trying to get one with a close on or near its high. We're just below the Globex high, so it looks like we'll break above the Globex high. Sometimes it gets right to the Globex high, does not break above it, and then reverses down to below the Globex low. Most of the time, if it races up to the Globex high, it's going to break above it. Bar 12, the end of the first hour. 12's behavior alters the appearance of the first 60-minute bar. At this moment, the first 60-minute bar is a bull bar closing near its high. We have a series of higher lows, and the bulls are hoping that this is a high 2 at the moving average. High 1, bear bar, not good. They're hoping this is a high 2, and that we get a resumption of the bull trend. The bears do not want the bar to close on its high, so they'll try to get a sell-off in the final minutes of the hour so that the 60-minute bar has a big tail on top. Bulls want the bar to close on its high, so they want 12 to close on or near its high. If it does, if it closes within a few ticks of the high of the bar, then I think traders will start looking at this as a buy the close rally. If it has a fairly big tail, traders will be less willing to buy the close. You can see we barely broke above the Globex high and stalled. Top of a trading range, a 7-hour trading range, still in breakout mode, not behaving as bullish as the bulls would like. So yeah, we broke out of the III, we broke out of the triangle, the trading range open, new high of the day, but 11 not especially big and did not close on its high. And 12 so far is not very big. However, if it does close on its high, we'll probably get a swing up from here. So the more 12 closes on the high of the bar, the more traders will buy the market and buy above 12. The bigger the tail on the top of 12, the more bulls will be disappointed and exit either at the market or below 12 or below 11 or below 7. And for the bears, they need a bear bar, and not just a 1 or 2 tick bear body. They need as good a bear bar as they can get. Otherwise, they'll wait for a second bar. Disappointing for the bulls. Consecutive bull bars with decent sized bodies, but neither one closed on the high of the bar. Always in long, but not strongly bullish. So it will reduce the number of bulls buying the market. And you can see that tail on 12, a lot of the bulls are exiting. The market is not doing what they want. For the bears, a failed breakout above the triangle, but consecutive bull bars, probably more buyers than sellers at the 12 low. So I would not short. I would either be long or be flat looking to buy or waiting for the bears to get a better reversal. I would not sell below 12 and I would not sell below 13. Now, who's selling 13? Is it bears saying, wow, what a great short? Or is it bulls saying, I'm disappointed 11 and 12 are not bigger. I'm disappointed they have tails on top. Maybe I'll exit and wait for another setup to buy again. It's mostly bulls giving up, disappointed. Probably more buyers than sellers, 12 low, not a good looking sell. Reversal, up on 11, 12, down on 13, closed below the moving average, but 12, bad sell signal bar. And traders do not want to sell too low. This is a pullback to the apex of the triangle, 10. So it looks like the bulls gave up, but they'll buy again above 14 if it's a decent bull bar. And for the bears, they need more. A bad sell signal bar, 12, and 13, a bear bar closing near its low, good, but big bar, big risk, and in the middle of a trading range, and after a bad sell signal bar, 12. So the bears need one more bar before a lot of bears will start selling. Now, 14, we have a reversal, 13, and 14 does not have a bull body, so bulls are not going to buy above 14. And for the bears, it's the minimum confirmation that they need for the reversal. So you'll get some bears selling the close. I'm flat. I did buy above 10, disappointed 12, and was quick to get out as 13 started to go down. So I'm back to flat. We're still probably always in long, higher low 14, 10, 7. But I'm not buying above 14, and I'm also not selling the close. So I'm waiting for more information, more bars. the market's telling you that this is just about a fair price. That's not good for swing traders. Swing traders need the price to be wrong and for it to be moving relentlessly toward a better price. That's not what we have. We're in the middle of a trading range. Market's deciding, should we go up, should we go down? And right now, I think we wait for the next signal. A bull inside bar and a higher low. So it's an okay swing buy. I would not buy for a scalp. Traders can always buy small, above 15 or 14, and then buy more if it converts into a small pullback bear trend. And for the bears that are hoping 13 is the start of a bear trend, 15 is a low one bear flag, but it's similar to 3 and 6 bull bar, so not a lot of bears will sell below. Neither side is doing enough to attract a lot of traders. Is it still a buy above 15? Well, we're getting higher lows, and now we have a higher high. So it's still a possible bull trend. I did not sell below 15, but I think it's an okay swing buy above 15 or above 14, or you wait to see if 16 or 17 is a bull bar closing near its high, and then buy above that. Getting higher lows and higher highs, a micro double bottom, but a bear bar. So not a great buy above 16. The high of 16 is at the high of 15, a bull bar. Some bulls will buy above 15 or above 14. And for the bears, a low one. They're hoping 13 is the start of a bear trend, but it's a bull bar and the middle of a trading range open. So I think it's still better to wait. The bigger 17 is, the more it closes on its high, the more bulls will buy it on its high. Some will buy above 14, the top of the trading range. Others will wait for 1 or 2 consecutive bull bars and then buy. And for the bears, it's a weak sell below 12, below 15. This is not a high probability buy. It's a reasonable buy. You can always buy more if it later, if it starts to get a buy the close trend like this, you can add on. Whenever you feel like the market's not quite doing what you want it to do, it's usually better to wait until it does exactly what you want it to do. No, I did not buy above 17. I think it's okay, but I really want better buying pressure, better evidence that the bulls are willing to buy. And the bulls get bars closing on or near their highs and closing above resistance. So a bull bar, good for the bulls, close at the 17 high. That's the minimum that the bulls want. So you'll start to attract some buyers at the market or above 18. And for the bears, a double top bear flag 15, but not a good sell below 18. So I still think it's probably slightly more bullish than bearish. But look at what we've done. We've been sideways in a very tight range since the open. So neither side has much of an advantage. Can the bulls get another bull bar, 19? Sometimes a bull trend will begin with doji bars, where all of the bars have bull bodies, 3 or 4 consecutive bull bars. So if the bulls can get that, that would increase the number of bulls willing to start to buy at the market. Bears trying to get a double top bear flag 15, but they need a bear bar closing near its low for a sell. Big outside down bar. Neckline of the double top bear flag 17 low. Bulls trying to get a double bottom at that low. And bears trying to get the breakout. The bulls should not have allowed 19 to happen. So right now, I think we'll probably break below 17. But selling at the bottom or buying at the top is not a high probability bet. So if you take it, trade small, and look to add on if it keeps going down, just like the bulls will add on if it keeps going up. Bulls want a higher low and a high to 17, and the bears are hoping this is the start of a move down to below yesterday's low. The more bear bars we get closing on or near their lows, the more bears will sell. They'll sell the market, sell closes. If we get a reversal up 20 with the bull body closing on its high, the bears will exit and the bulls will buy again. The more 20 closes on its low, the more bears will be willing to sell the market, sell below 20. The more conspicuous the tail on the bottom of 20, the fewer bears will sell. And for the bulls to buy, they need a bull bar 20 or 21. More conspicuous the tail on the bottom of 20, the fewer bears will sell. And for the bulls to buy, they need a bull bar 20 or 21. Not quite as good as the bears would like, but it's probably always in short and probably sell the close. That tail on the bottom of 20 and the body not being big will make a lot of the bears scalp out at least part. And that's why we're getting the reversal of 21. For the bulls, a double bottom 4, a high 2, 17, and a triangle. I said we might get a triangle. So we have 1, 2, 3, 4, 5. The more 21 closes on its high, the more bulls will buy, and the more bears will exit. I did sell on a stop below 19, and I bought back my shorts as 21 started to churn up, so I'm back to flat. The more 21 closes on its high, the more bulls will buy, taking a chance that we're getting a swing up. So that's decent for the bulls. The bears are hoping 22 becomes a low one sell signal bar. But for the bears, I'd get out of shorts above 21. And bulls, they can either buy above 21 or they could wait for a second bull bar. The bears who do get out can sell again below a bear bar. Maybe 22 will be a decent bear bar. For the bears to short below 22, they'll want a decent sized bear body, at least 3 or 4 ticks, and they'd like the bar to close near its low. And the bulls are hoping this is the start of a bull trend. So far, they're disappointed that 22 is not bigger. So if it has a bull body but a small bull body, a lot of the bulls will be fairly quick to get out. If it has a bear body, they'll get out below 22. If it has a big bear body, the bears will short below 22. Some disappointed bulls are exiting at the market. I think it's okay to keep a stop below 21 or to get out below a bear bar closing below its midpoint near the low of the bar. If it's a 1 or a 2 tick bear body, it's okay to keep the stop below 21. But so far, this is a disappointment for the bulls. And that tail on the top of 22, a lot of it is disappointed bulls exiting. They wanted the market to race up like yesterday, 25. And because it did not and stopped at the 2 moving averages, a lot of the bulls exited, and that's what created that tail on the top of 22. For the bears, it's a low one, but probably buyers below 22. The bulls who are still long are eager to see a strong bull bar. So they'll be, if they did not get out during 22, and 23 is not a strong bull bar, more bulls will exit. And the low one bears, they want to see a bear bar with a decent body and closing near its low. At a minimum, the bulls want to avoid bear bodies, even small bear bodies. And the bears need bear bodies. They need bear bars closing near their lows. We're still in breakout mode. The market's still deciding on direction. The bulls got the minimum that they need, no bear body, and the bears do not have enough to short below 22 or 23. So it's still on the buy above 21, but stop below 21 or exit below a bear bar. Bulls really need this to get going because, some bulls get out on 22, others get out on 23. And if we do not go up soon, the remaining bulls will exit and we'll get a big bear bar as they panic. Good bull bar, so you'll get more bulls buying, close above the moving average. Some bulls will wait for consecutive good bull bars, but we're still on that buy above 21. Bears want a low 2, 22, another failed attempt to get above the two moving averages. We've been failing all day. Look how many times we've tried to get above the moving average. Here we had a pretty good attempt, but it failed. It's really interesting how many times we've tried to get above. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Out of 24 bars, most bars today were attempts to break above the moving average. Look at the two moving averages. They're flat and they're on top of one another. A sign that the market is sideways on the 5-minute chart and the 60-minute chart. Bulls, they'll get out below a bear bar, especially a bear bar closing near its low. And bears, it's another double top. Now, double top 19, low 2, 22. If 25 does not get much bigger, and if it closes near its low, bears will short again. Trading range open, reversing every bar or two. So a lot of the trend traders are entering, but they're disappointed and then they get out. They get out and they hope to get out without a loss, hope to get out with a few ticks profit, but not always possible. I did buy above 21, disappointed 22, and then get out with a few ticks profit 23, so I'm back to flat. I'm going to extend this line down, and you can see that this is a failed breakout above the top of the triangle. I'm trying to get the triangle lined up. Triangle, breakout mode, just like any other breakout mode pattern. 50% chance the first breakout will fail. We had an I here, breakout mode. We have a tight trading range here and a bigger triangle here, breakout mode. We broke out, it failed. We're breaking to the downside, it failed. And now we're breaking above the triangle, and it's failing. Can you sell below 25? A lower high and a bear channel. So We have a high, a lower high, lower high, lower high. Well, it's a tight trading range, and 24 is a bad sell signal bar. In 25, you're selling low in the range. So, I'm going to wait to see if we get consecutive bear bars and then sell again. I've had a lot of small trades today, 2 or 3 ticks profit. Sometimes I had bigger profit and it became small profit. Buying above 10, selling below 19. I got out with a small profit both times. Remember, when the market's in a trading range open or any kind of a breakout mode pattern, something that looks bullish, they sell it. They sell the close of 11, they sell the close of 12, they sell the close of 24. And anything that looks bearish, they buy. They buy the close of 1, the close of 7, the close of 13, the close of 19, the close of 20, and the close of 25. They bet that attempts to begin a trend will fail, and that every strong move up or down will quickly reverse. So they're betting against the trend traders. These are the limit order traders. Limit order traders are betting against any trend, and they're scalping, and the trend traders are entering with stops, betting on a trend, and they're trying to swing trade, but they're repeatedly disappointed, and they're exiting pretty quickly. Bulls trying to get another buy signal bar, but they want 26 to be as big a bull bar as they can get, and they want it to close on its high. The bears are hoping 26 will be a bear bar after the outside down 25. Still breakout mode. If 26 closes on its low, you'll probably get some sell to close bears. If it closes on its high, you'll get some stop order bulls. If it does anything other than those two things, a lot of traders will wait. What happens if it has a 2-tick bull body? Fewer bulls will buy. Bulls want the bar to close on or near its high. Smaller body than 21, but okay swing buy. And a lot of bulls are disappointed that 26 did not close on its high and did not have a bigger body, but it's a credible swing buy. And for the bears, they're hoping 27 will be a bear bar. Whether or not it goes above 26, they want a bear bar. They're hoping that 25 is the start of a bear trend and that 26 is a pullback. Traders looking for higher probability will wait for stronger setups. Still breakout mode. Trading range open and a triangle since yesterday. Instead of triggering the buy above 26, we have outside down, and we broke below 26 and below the bottom of the triangle. Is it always in short? Probably always in short. Is it sell to close? I think you'll have fewer traders selling the close. A lot of traders will wait for a follow-through bar, and the bulls will hope for a reversal up, maybe a wedge 14.21. I had a stop order to buy above 26 and did not get filled. My thought was buy a small position, and then if it begins a trend, buy more as it goes up. You can see bulls bought the close of 27, big bear bar, breakout below 21, but still a trading range open. So you still have bulls buying bear closes. Bulls hoping for a failed breakout below the triangle, a double bottom 4, a wedge 14.21, and bears would like to get the second consecutive bear bar, especially a big bear bar closing on its low. If they get it, then we'll probably go below yesterday's low. Remember, yesterday is a sell signal bar on the daily chart, but a bad one. It has a bear body, good for the bears, but a big tail and a strong bull trend. I talked about the wedge bull flag possibility, 3 lows, 14, 21. 14 is not obvious. Another way to look at it is just look at the legs down. Big bear bar 13, a pair of bars 19, 20, and then this sell off, a pair of bear bars. For the bulls, not a good buy, despite the wedge and the higher low double bottom and the failed breakout below the triangle. For the bears, it's an inside bar in a bear trend, so it's a low one, but it has a bull body, and we're at the bottom of a trading range. So not a good stop entry buy above 28, not a good stop entry sell below 28. We're probably always in short. Bears, I'd get out either a tick above 28 or a point or two above 28, or a tick above a bull bar closing near its high. And for the bulls, I would want to see a decent buy signal bar. So right now the bears are still short, but they might get out a point or two above 28. And not a lot of bears sold after 27, and not a lot of bears will sell below 28. Possible measuring gap, 28 high, 26 low. We have a lower high double top here, neckline here, possible measure move down, and then we have a breakout here, 27, possible measure move down there. So that would get us there. It's around the same as the double top bear flag, neckline, measure move down right at yesterday's low. So that's no coincidence. This 21 low and that 25 high are exactly where they have to be, so that the measure move down would be at yesterday's low. Can you sell at the market and get out a tick above 28 or a point or two above 28? I mean, it's always in short. You could do it, but you're selling at the low of a swing down, and the swing down is not particularly bearish. We're not getting consecutive big bear bars. We're not getting relentless selling. We're getting hesitation, 26, 28. Sometimes the trading range open continues all day, and the day it's then a small trading range day. Usually not. Normally you're going to get at least one swing up or down. Bears are hoping that this is the start of it, but a bad sell signal bar 28. Bulls are hoping it's a higher low double bottom 2, but a bad buy signal bar. So not a good stop entry, sell below or buy above. We're on the short. I'd get out a point or so above 28, a tick above a bull bar closing near its high. Bear flag, credible sell for a swing, but 50-50 chance the breakout above or below will fail. And for the bulls, it's an buy, but the bear body lowers the probability for the bulls. So reasonable swing buy above 29, reasonable swing sell below 29, but 50-50 chance the breakout up or down will reverse. If you want higher probability, you wait to see what the breakout looks like. That triggers the buy signal. All right, so if you buy above 29, stop below 29, and you're hoping for a swing up. But if you're disappointed, like 22 or 18 or whatever, you'll exit quickly before your stop gets hit. The bulls who did not buy above 29 will wait for one or two more bull bars, 30 or 30-31. But if it's right below the moving average, a lot of them will wait for a breakout above the moving average and then buy. Can the bulls start to get consecutive bull bars? Can they get 2 bull bars? Can they get 3 bull bars? Can they get bull bars closing near their highs? Can they get a close above the moving average? Can they get a close far above the moving average? The more of those things they do, the more likely we'll get back up to the high of the day. But if they fail to do those things, and if we fail again at the moving average like we've been doing all day, then we'll probably get down below yesterday's low. I did buy, by the way, above 29, despite the bear body, simply because it's an II at the bottom of a trailing range day. This was the FOMC minutes. I normally don't check to see when they come out, and I do know when the FOMC days come out, but when you see a bar like that, at 11 o'clock Pacific time, I know it's the FOMC minutes. Some traders would sell below the bear bar. Some would wait for consecutive bear bars and then sell the close. Stop theoretically up here, which is very far. Alternatively, you can get a point or two above any bear bar. Once you get 3 or 4 consecutive bear bars after an FOMC announcement, you're probably going to get some profit taking. And here we got a little bit of a bounce. A bear breakout on the FOMC. Here we had a trend, but it was not nearly as climactic as what we have today. This is kind of like today. When you get these plunges, there's a bigger chance of pretty aggressive profit taking. Here, it went back to the moving average and retraced about half of that. So I think we're probably going to bounce soon. Again, this lasted all day, bear trend, but it's not as climactic. The bars are not as big. We don't have 4 consecutive bear bars. So you don't get exhausted bears. If you get a lot of big bear bars, you have a higher probability of a pretty sharp reversal. Very big bear bars here. We got higher low double bottom, a high 2, and a big reversal up. Here, not much of an announcement. This is possibly like today. I doubt we're going to get that much of a reversal, but I suspect we'll get some kind of a bounce. Again, here we tried to reverse repeatedly. We're not getting that kind of buying today, so it's unlikely we'll retrace the whole sell-off. So, but we may get a 50% bounce. Might get one more leg down and then reversal. But this kind of selling usually attracts profit takers. We have a couple magnets below the November high, and then the low of last week. This week might become an outside down week. Monthly chart, that's the November high. Daily chart, it was the high for over a month. We broke above it. We're pulling back and we're testing it today. We're also testing this high. If you remember, I said that if this is going to be a wedge, 1 pullback, 2 pullback, 3, we probably will have to dip below that high, because when you have a wedge, normally the pullback from the second leg up overlaps the top of the first leg. So we should pull back above that, pull back below that high, either today or probably tomorrow. Bulls, they want to buy, but they want 61 to close near its high. Then they'll have a micro double bottom with a decent bull bar. But it probably would be a minor reversal. And for the bears, we're starting to get tails. Tail, bull bar, tail, top and bottom. Right, so there's some buying going on. It's mostly bears taking partial profits. It's still sell the close, but once you start to get dojis and tails, it's usually better to look to sell above things and sell rallies rather than sell at the low. That's the minimum objective. A test of that November high, which is the breakout point on the daily chart. We also broke above the November. Actually, no, this is the breakout point. This is the one that I think we have to dip below. And obviously just broke below the November high. I got to put down, let me see, I may have it down there. Let me see. Nope. I got to put that down there. December 16th high. This is the high. I think that's an important price. This is a 60-minute chart. You can see some hesitation. We have a sell climax here, and then another big bear bar, so another sell climax here. And if the bulls get a bull bar closing on its high 62, bears will exit a high 258 consecutive sell climaxes, and bulls will buy looking for a bounce, probably only a minor reversal. But I would get out of shorts above any bull bar. At this point, consecutive sell climaxes down to a target zone. For bulls to buy, they want as strong a bull bar as they can get. So they want bull bars with big bodies and closing near their highs if you're going to be buying in a sell climax. Here we got a 2-bar reversal, but closing near its high. Rallied sharply, but came back down. Minor reversal. When the sell-off is that strong and you reverse up, you're probably going to get a minor reversal. Very strong sell-off, bull bar closing near its high. Got a couple legs up to the moving average. If it has a fairly conspicuous tail on top, I think it's okay for bears to get out, but the bulls really want some sign that the bulls are buying into the close of a bar. They only buy into the close of a bar if they expect the price to go higher. So if you do not get the bar closing on its high, traders are concerned, bulls are concerned that there's just not enough buying. So a lot of the bulls will wait for a bull bar closing near its high. How big a tail on top? Pick a number, a point or so, 6 ticks, 7 ticks. If it's a relatively conspicuous tail, bulls will not buy. At this point, bears, I would get out above any bull bar, and I would get out a point or two above even a bear bar, because chances are these tails, they indicate profit taking. They increase the chance that we're going to get a bounce soon. I think we're going down below this blue line, December 16th high. I don't know that we'll do it today, but I do think we're going down there either today or tomorrow, because that's what normally happens. Normally, if you have deep pullbacks and a possible wedge, the second leg up tends to pull back below the top of the first leg up, which is December 16th high. Upside down week, we went above last week's high, and now we're going below last week's low. Good for the bears, but I think we have to get below that December 16th high. As I said, I don't know if we'll get there today. It looks like we have a good chance of getting there today. And we don't have to stop there. We could just keep selling off all day. This could be a measuring gap, 62 high, 60 low. I think it more likely will be an exhaustion gap. Once you get a sell climax that starts to have dojis, you're probably going to soon enter a trading range. But no bottom yet, nothing to buy yet. Tough to sell at this point. Once you start to get trading range behavior, bears are less willing to sell at the low. The high frequency trading firms, they'll sell, they'll sell constantly looking for a 1 or 2 tick profit and then sell again. They see this magnet below. Right? Most experienced traders see that magnet below. But sometimes the market will race down to a magnet and suddenly reverse up sharply just above the magnet. It's kind of funny to see the sell-off on the FOMC announcement, because everybody knows the Fed is going to increase rates and they're going to stop the taper a lot sooner than what they said. I've been saying that for a year, that they've been lying about what they're going to do, and that they're going to increase rates sooner and more often and bigger than what they've been saying, and that they would taper faster than what they've been saying. I think lower probability selling at the low, and probably not much profit remaining for the bears. So if you start to see a market that might be transitioning into a trading range, you start to transition from selling the close or selling below bars to selling above bars and selling low 1 and low 2 pullbacks. Okay, we're right at that high. We don't have to go just one tick below and then reverse up. We could easily go 10 or 20 points below. I don't think we'll go that far below today, but it's possible. This is a really strong bear trend. If you are short and you have not taken partial profits, I would take some partial profits here. We're also getting near the 20-day moving average, another magnet. We're very close to it. We're below the December 16th breakout point. And the bulls hope that this is just a test of that breakout point, and that will reverse up in the next few days and then get another leg up. And bears are hoping that it's already a wedge, 1, 2, and 3, and that this is the start of a trend reversal down to the December low, maybe the October low. So is 63 buy the close or sell the close? 55, 56, 57, 58, all sell the close. 61 sell the close. Now we have a third leg down. I think it's better to sell rallies at this point instead of selling closes. And as I said, the bulls really need a pretty good bull bar. It doesn't have to be a huge bull bar, but they really need a bull bar closing near its high. And until that happens, the bears are going to continue to sell. 3 legs down, 3 consecutive sell complexes, 1, pause, 2, pause, and 3, and at the lowest target that I have for the day. So I think bears should buy back shorts. They can buy back at the market or above a bull bar. 64 might be a bull bar. And the more 64 closes on its high, the more bulls will be willing to buy and take a chance that we're going to get a sharp short covering rally. If there's a conspicuous tail, big tail, a lot of the bulls will wait for a second bull bar. Another minute to go before we find out how bullish it is and get an idea whether bulls will buy. I think bears should get out. And bulls, it's probably a reasonable buy for a parabolic wedge. Stop below 64. Or you buy more below 64. If you're able to trade small, you buy more below 64 and use a wide stop, probably somewhere down here. You can see some bears are hoping 64 is a trap. They're selling the 64 high, trying to trap the bulls. But I would get out. I would get out of shorts and either be long or flat. Bears want to get a low 1. They're trying to have 65 be a bear bar closing on its low. But after a parabolic wedge and a very good bull bar at the lowest magnet that I have for the day, I would wait for a couple legs up before selling again. Bulls, they can get out below a bear bar closing near its low. They can get out below 64, or if they're trading small, they can use a wide stop and hold long with, maybe a stop somewhere down here, maybe a measure move based on that. And for the bears, they have a low 1, but a parabolic wedge, a good buy signal bar at support, and then a bull doji for their low 1 sell signal bar. So it's a low probability short. You can argue that it's still a bear trend, which it is, and therefore you have to get short again if you exited above 64. And there are 2 ways to do it. One is you wait for a bear bar closing near its low and sell below it. And the other way is to sell at a new low, which I would not do after a parabolic wedge. So for the bears, I would wait for a couple legs up before looking to sell again. And for the bulls, it's not yet doing what they want. Testing the December 16th high again. For the bears, a low 1, 65. There might be more buyers than sellers below 65. I suspect there'll be more buyers than sellers below 64. So I think it's climactic enough so that traders will start buying below things, below 65, below 64. You can see we dipped below 65, and there were some buyers, but will there be enough buyers to start to get a series of bull bars? What happens if 66 closes on its low, but above the 64 low? It's reasonable to get out of longs below a strong bear bar. You can always buy again on a reversal up above 65 or above a bull bar closing near its high. Now, some bulls who bought above 64 are disappointed at 65, 66, and they want to get out. So there are some bulls who will be selling around the 64 high. If they're disappointed enough, instead of selling with a limit order at the 64 high, they might have put a limit order to sell a point or so below the 64 high. You can see, well, you can't see right now, but the market did go up a little bit during 66 and then sold off again. And part of that is the disappointed bulls who are relieved to be able to get out with a smaller loss. So how strong will the bulls be? Will we start to get bull bars closing near their highs? Will we start to get a series of bull bars? Or are we going to get weak-looking bull bars? If you get strong-looking bull bars, more and more bears will buy back shorts and more bulls will buy. If you don't get strong bull bars, bears will hold short and look to sell, and bulls will get out and wait to buy. This is the end of the hour, and the 60-minute bar is a big bear bar closing near its low. So we may have to go below the low of that bar, which means we may have to go below 64 for the 60-minute traders. Not great for the bulls, not great for the bears. So you'll get more and more bulls exiting, and then they'll look to buy again. They can buy above a bull bar closing near its high, or they can buy a breakout of the prior high, 65. And for the bears, I still would not short. That's still not strong enough to short. I still think we're going to try to go up. What I don't know is whether we're going to go below 64 and then go up, or if we've begun the move up with 64. Nobody knows. I'm wrong about the 60-minute bar. The 60-minute low is over here, so we're already at below the low of the last hour. Now, will there be more traders buying the 64 low or more traders selling the 64 low? If we get a pretty good bull bar 67, that would be a second reversal up from important support, and you'll get more bulls buying. The bulls who are long will buy more. The bulls who exited will buy again. And for the bears, they will get out of shorts. If they shorted again below 66 or 64, they will get out of shorts above a bull bar, especially the bull bar closing near its high. So are we going to get a second reversal up, or is this going to be a successful breakout? And will we get down to 4,700? I think risky to sell the close because we had that good reversal 64. So we're getting some short covering. And for the bulls, they need another bar that looks like 64. For the bears, it's still sell for whatever reason, but we may get a micro double bottom here. The market's still deciding if the 67 breakout is going to succeed or fail. Still strong selling. There's the 4,700 big round number. And then that is a gap from the other day. Here's the 15-minute chart. 60-minute chart, we had a gap up over here. Tail. So that will reduce the number of sell the closed bears. For the bulls, a high 264 but a pretty good sized bear body. So that will reduce the number of bulls buying above 68. I think the bulls would rather wait for a bull bar. You had some limit order bulls 64 low, and we should get above that. There was a reasonable buy above 64. Disappointed bulls 65, 66 never had a chance to get out break even. So some of those bulls are still long, and they'll buy more lower, trying to get up to that 64 high. So 64 high and 64 low are both magnets. But unless we get a bull bar closing near its high, I think the bulls will wait. If 69 closes near its high, bears would get out. I think it's an okay buy. You're hoping for a short covering rally, possibly lasting for the remainder of the day. Really tight bear channel, so any reversal will probably be minor. If the bulls are lucky, we'll get to the 64 high, maybe the moving average. Less likely we'll get all the way up here. For the bears, it's another low one. But if we do go down, we'll probably get reversal from a parabolic wedge. I think it's important to notice that 69 did not go above 64, so the limit order bulls were unable to make money, at least so far. For the bears, a low one, but a bull bar and a third leg down, 64, 68. That will reduce the number of bears selling below 69. I would get out of shorts above 69, and it's an okay swing buy above 69. If you want higher probability, you wait to see if we get a second bull bar and a bull bar closing on its high. We might get an II here. We had a couple earlier today. We had an III over here, and then we had at least one other II. I don't see it right now, but I know we had at least one other one. Market's deciding, are we going to get a third leg down to the 4,700 big run number and then a reversal up, or are we going to get a reversal up here? Can we just keep going down into the close? It's possible, but it's unlikely. You buy above the bear bar, 70. Theoretically, it's a buy, but I'd rather buy above a bull bar, 69, or wait for a bull bar, 71 or 72. And for the bears, it's a low one and a magnet below and a very strong bear trend, but it's a third leg down, so there's an increased chance of buyers below. So I would not take the short. I would either take the buy above 69 or wait to see what 71 looks like, and if it's a decent bull bar, buy above that. Selling is stopping. You know, it may resume again. We still have the 4,700 big round number, but it's pausing at least. Fewer bears are willing to sell, but the bulls are not getting what they need. So the bulls, you can argue it's still a buy above the bull bar 69. I would get out of shorts above a bull bar 69, but a lot of bulls will wait for another bull bar closing on or near its high. This is the end of the hour, and the hour is closing near its low. At least right now it's near its low. And the market might want to go below the low of that bar on the 60-minute chart. So we might have to dip below 68 before the bulls will buy. If we do go below 68 in reverse, it'll be a small wedge bottom, 64, 68. And the bears are hoping that we just keep selling off all day. I think we'll probably get some profit taking before the end of the day. So some kind of a bounce, but we're running out of time. And instead of reversing up, we're going sideways. And that's a problem for the bulls. The bulls really need this to reverse up in the next maybe a couple of hours or so. Otherwise, we'll probably just end the day in a tight trading range. That's the end of the hour. And on the 60-minute chart, we have consecutive very big bear bars closing on their lows. So we're probably going to go at least a little bit lower. And, might go a little bit lower today, but even if we bounce tomorrow, we're probably going to go lower. This is probably going to lead to a second leg down. That pink line is a gap. That's the top of the gap. That's the bottom of the gap. And then we also have the 4,700 big round number. What happens if we do not get a credible buy by bar 75? I think a lot of the bulls will wait for tomorrow. If it stays in a tight trading range at bar 75, bar 76, usually you're not going to get much of a rally. So if the bulls are going to get a rally, they really have to do it on this bar or the next bar. They have to do it pretty soon. High too, but that's not going to attract a lot of buyers, a bear doji and a really strong bear trend. Bears, they can get out a point or two below, a point or two above any bar. We're not getting good shorts either, below 70, below 72. I think it's important that 69 did not go above 64. So the limit order bulls who bought the 64 low and bought more lower were unable to make money. And that's a sign of strong bears. Normally, the bulls would be able to make money. This is bar 74. And this is typically the final bar of the day when I will take a stop entry trade. So the bulls need 74 to close on its high. The bears would like it to close on its low, but I'm not sure how much lower we'll go. We're starting to go sideways here. We've got 7 small sideways bars. So even though we have a magnet at 4,700, we're probably not going much lower. And the bulls have a chance of a quick rally back up to the moving average and the 64 high. But traders are only going to buy if 74 closes on its high. They want a good buy signal bar. Bulls trying to break above 69. They're trying to get above the 64 low, and they're trying to get up to the 64 high in the moving average. You see what just happened there? We went just above the 64 low and sold off. And that's because a lot of the bulls who bought the 64 low and bought more lower are so disappointed by the strength of the bear trend that they were happy to get out, break even on the 64 buy and with a profit on the lower buy. So a lot of that tail, 74, is disappointed bulls who bought the 64 low and bought more lower, exiting. We do not have what I think stop entry traders needed. This is bar 75. My rule is if there's not a good stop entry by stop entry signal by 75, which is the current bar, I don't take any more trades today. And a lot of times bar 74 will be the last signal bar that I'll trade. Now, what about shorting below 75? You can call it a low 1. You can call it a double top 69. You can call it a low 270. But it's bar 75. It's getting late in the day. My general rule is if you do not have a move by bar 75, if you have a tight trading range of 4 or more bars by bar 75, I usually don't trade. I got to say, I was tempted to short below 75, but I ended up not taking the trade. The bear trend is so strong, and the 4,700 big round number is a magnet below, and 75 is a good sell signal bar. But the later it is in the day, the lower the probability that stop entry signals will be profitable if you're in a tight trading range. So I let it go. The reason I was tempted is it's a really good sell signal bar, and it's a very strong bear trend, and there are magnets below 4,700 and then that gap. But the tight trading range and the time of the day, that combination, I rarely will take a stop entry trade and trade at bar 75 or later. Can you still sell the close? Sell below 76. It's getting late in the day, and you have to be really quick to make decisions. So I usually will not do it, especially coming out of a tight trading range. I'm going to wait for tomorrow. Even if 77 is a great bull bar, in a final flag reversal, in a wedge, 64, 68, a test of the 4,700 big round number. But it's late in the day, and we've had a tight trading range late in the day, and that usually reduces the chances that the market's going to move very far. I debated taking that 75 short, and I did not. I don't really worry about missing trades. All I care about is, if I take a trade, does the trade make sense, and am I managing it well? I miss trades all the time. Every trader does, and that's really not a problem, because there are always many more other trades. The key thing that can be a problem is if you take bad trades, or if you take a bad trade and do not immediately get out, or take a good trade and manage it badly. Those are things that cause you to lose money. Missing trades, you don't lose money, but taking bad trades and managing trades poorly that makes you lose money. Pretty unusual sell-off on the FOMC announcement. It was the minutes and not even the FOMC announcement itself. But part of the reason why it sold off so much is the rally last week was so strong. When you get these huge rallies, a lot of times you'll get a very deep correction. The bulls were hoping that whatever we get is a pullback from this. The bears are hoping that we're reversing down from a wedge top, and that this is going to be the high of the year. Last year closed near the high of the year. This year, you'd expect this year to go at least a little bit above last year's high, and we did right here. And now we're reversing down. The bears are hoping it's a wedge top, 1, 2, 3, but they still need more bars down. As you know, I think the market's going to be in a trading range for several months. I don't yet know if this is the top of the range. I think the bottom of the range will either be here or here. But we'll have to see. We have a wedge, 1, 2, 3. We're at the top of the channel. And a wedge typically will attract profit takers. And if a bull takes profits after a huge trend, he's not looking to buy again a bar or two later. He's going to wait 10 or 20 bars before looking to buy again. And that absence of buying often leads to a pretty good retracement. And the first target is always the most recent high or low, here or here. We may bounce there. If we bounce there, let's say we get here and we bounce, then the bears will look for a lower high major trend reversal, head and shoulders top, left shoulder, head, and then right shoulder, and then a breakout and a measure move down to the October low. I do think we're going to get down to the October low sometime in the first half of this year. I don't know that we've finished going up yet. We still might get another leg up. There are different measured move targets. Plus, this is so strong, the wedge count may have reset. So instead of 1, 2, 3, it might be 1, and then a new 1, 2, and then sell off, and then 3. Don't know yet. If the bears get another 1 or 2 big bear bars, then this probably will be the high for the next several months. And we'll probably come down here, maybe down here. It's really, I think, amusing that the market is selling off on the Fed announcement. I say that because, I'm not an economist, I'm an eye surgeon. And if a regular guy like me can conclude that the Fed has been lying and that they're going to have to be much more aggressive in what they're doing, I'm sure all the economists and traders at the major firms already know that. However, a lot of traders, a lot of firms will just keep buying until the market stops going up. And a lot of this is profit taking from institutional traders concerned that the Fed might be more aggressive than what they believed prior to today's announcement. But no matter how big a sell-off, I still believe that it's more likely we're going to go back up to a new high in the next few weeks than that this is the top. Top picking in a strong bull trend is a losing strategy. Here's the daily chart. Here's the weekly chart. We've had tops all the way up, but at no point did the probability of a trend reversal become better than 50-50. There were a couple times when the bears had a 50% chance of getting a trend reversal, but they've never had better than a 50% chance. That means that the probability was always 50 to 60% chance that every sell-off, every bear bar, every series of bear bars would be brief and that we would get a new high. And that's still the case here. So, and even if we were to come all the way down here to the October low, which I think we're going to reach at some point this year, we'll probably get a double bottom, and you have to assume we'll end up going higher. Monthly chart, we have a parabolic wedge, 1 pullback, 2 pullback, 3, and so far January is a reversal. I said that if December went outside up, January or February would probably be a reversal and lead to a test of either the December low or the October low. But when a bull trend looks like this, it's unlikely to become a bear trend without first going sideways for a lot of bars. So even if we were to go sideways for 6 months or more, it will still more likely be a bull flag than the start of a bear trend reversal. Today, FOMC days, a lot of times it's like 2 different days. And today's a day like that where we had the market behaving one way before the report and then another way after the report. And ahead of the report, the bulls were hoping for a head and shoulders bottom, left shoulder head, right shoulder. You can call it a bear trend, strong minor reversal, and then a higher low major trend reversal. But I talked about how the bulls were having a problem getting good buy signal bars, 2 and 4 and 10 and 17. And the other thing I talked about was the surprising number of bars that broke above the moving average but could not close above the moving average. And in here, it's really bad for stop entry traders. You don't want to buy above 2 or maybe you buy above 10. It's a III breakout mode, plus it's the apex of a triangle, so buying above 10 makes sense. Excuse me. But selling below 13, not so good. 14 is interesting. It's a doji bar after a bear reversal. That's the minimum confirmation that the bears want to see. So 14 made it always in short. It made it more likely that we'd go down at least a little bit more. The bulls, a tight trading range of micro double bottom, 17, but I said I wouldn't buy it. And then the bears got outside down, 19, 20 consecutive bear bars, but really not all that bearish. You could sell the close 19, 20, but I would get out of shorts above 21. And for the bulls, it's a double bottom 4, a test of the open of the year, a good bull bar closing near its high. I think it's a reasonable buy. But I also said that the entry bar 22 and the follow-through bar 23 were disappointing. And when that happens, if you don't get a pretty good sized bull bar soon, the bulls will give up. And the bulls got to close above the moving average on 24, but just above and not a very big bar. And they gave up on 25. So 25 is more bulls giving up than it is bears shorting. But the bulls are giving up. Bulls trying to get a high 2 with 26, but a weaker looking buy signal bar, especially after that big bear bar 25. So I would not take that buy. We tried to break above the top of the triangle, and now we're trying to break below the bottom of the triangle. Then we got an II. It's a breakout mode pattern. For the bears, it's a bear flag. And for the bulls, it's, you can call it whatever. You can call it a double bottom 4. You can call it a wedge, 3 legs down, 1, 2, and 3. So you can call it a wedge, bull flag. but it has a bear body and we're just below the moving average. It's an okay buy, but if you take the buy, you need the market to start to get pretty good bull bars, and you especially need a breakout far above the moving average. And without that, I think that's, the probability is not very good that we're going to go a lot higher. 30, not a good entry bar. 31, a good follow-through bar, but the bulls need another good bull bar. If they don't get it, bulls will dump. Bear bar 32, closing below its midpoint. I would get out of longs below 32, but the tail on the bottom of 32 is not good enough for me to sell with a stop below 32. And then we rallied for 4 consecutive bull bars, and but failed at the 60-minute moving average. And for the bears, it's a wedge rally, micro wedge, 3 legs up, 1, 2, pause, 3, and a double top. When you have a double top or a double top bear flag, 30% of the time, the second leg up is a buy climax. It's a strong rally. And here, it's, I don't know, a 10-bar bull microchannel, low pullback since the 27 low. So it's a pretty strong leg up. But 30% of the time, that's what happens. It's 36 for bull bars. I don't want to sell below 36, but I'll consider selling if we get a bear bar 37, which we had. And then bear follow through bar 38. So you look at that and say, oh, that's a surprise. I wasn't expecting that. And whenever there's a surprise, you're probably going to get at least a second leg sideways to down, and therefore it's a sell to close market. Bulls try to get a micro double bottom, 43, 41, but it's only a doji bar, and the buy did not trigger. And then here we have the biggest, or a very big bear bar, 44, late in a bear trend since 12, and it's a second sell climax, 1 pullback 2. And this is a really common situation where you have a trading range and a breakout below the trading range, and you have 2 possibilities. Well, you got 2, well, 3 possibilities. One is it's going to remain a bear trend. That's the least likely. When you have bars that look like this, prominent tails, these are hesitation bars, and they're more common in either a trading range or a bear leg that's about to reverse. And that means that either we're going to form a lower trading range or we're going to reverse back up, and the breakout below the upper trading range will fail. 45, not a very strong buy signal bar. 46, not a good entry bar. 47, not strong follow through tail, but we should get a couple legs up. It's fairly climactic, and we should get a couple legs up. However, on the days when you get a bear break below a trading range and then a reversal back up, you're going to get stronger bull bars than 45, 46, 47. And therefore, this is probably not going to be one of those trading range days with a strong breakout and then an immediate reversal up. That increases the chances that we're going to form a lower trading range and get a trending trading range day, a trading range, a brief breakout, and then another trading range. Bulls, a high 148, but a bear bar, a high 150, but a doji, and 3 dojis, and just below the moving average. And we failed at the moving average all day, right? So I do not want to be buying just below the moving average. For the bears, a low 2 bear flag at the moving average, but 4 dojis, and we might get a second leg up after 45. So it looks like a limit order market. I don't want to buy above 50. I don't want to sell below 51. And that means I think there are buyers below bars and sellers above bars. I think it's a limit order market in a trading range. Then we had a bull inside bar, 53. And then I didn't realize that today was an FOMC minutes day. In general, FOMC day or an FOMC minutes day, I'll get flat ahead of the report and then wait for a couple bars before trading again. And you can see 55, a huge outside down bar. We went up to the 60-minute moving average and reversed down. So you can call it a double top pullback, double top 25, 36, and this is just a pullback. Really big bear bar closing on its low. You could sell below. A lot of traders will wait for a second bear bar, which they got on 55. So you can sell the close of 55 or below 55, but the bars are big. So you have to trade small. Theoretically, the stop is above 55. No one wants to risk that much. As an alternative, you can get out above any bull bar. You can get out above a bear bar 56, but not one tick above, maybe a point or two or three above, or you can get out above a 50% retracement. So there's the low of the bar, that's the top of the move, here's 50%, so you could get out just above 50%, maybe a point or two above 50%, instead of all the way up 55. And we just sold off dramatically. Sell the close, a bull bar 59. It's possible that it's a sell climax of a micro wedge, 57, 58, 59, but did not close on its high. So a lot of bulls, 59, they'll wait for a bull bar closing on its high, which we did not get. The bears got outside down, but 4 bars with tails, 57, 58, 59, 60. That will reduce the number of bears selling below 60. The bears who want to trade always in short, if they get out above 57, they'll sell either at a new low below 57 or below a bear bar closing near its low. Maybe 60, maybe 61. And 61 is another very big bear bar closing on its low. Probably will get at least a small second leg down. It still sell the close, but the bars are huge. So if you sell, you have to trade small. Tail 62, so some profit taking into the close of the bar. That increases the chances that we'll get a bounce or a reversal soon. Really good bull bar 64, closing on its high. A reasonable buy, looking for a reversal up, a sell climax. On the daily chart, I said we should fall below the December 16th high, because if this is going to be a wedge rally, normally the legs overlap. Just like this fell below that. We broke out above this, we should fall below it, which we did today. And we'll see. If we get a bull bar tomorrow or a micro double bottom over the next couple of days, bulls will buy again, looking for another new high. But if tomorrow looks like today, we'll probably get down to the December 3rd low. If we do get there, we'll probably bounce, and then traders will wonder, will the bounce form a lower high, major trend reversal, and a head and shoulder stop? So reasonable to buy above 64. You can wait for consecutive bull bars closing near their highs, but reasonable to buy. And I said 65 is disappointing for the bulls. It's a weak entry bar. You want this to race up. For the bears, 65 is a low one, but it's a bull doji and a sell climax at support after a really good buy signal bar. So most bears are not going to sell below 64. Went sideways for a number of bars here. No, wrong. Okay. Here, 66 closing below its midpoint. Theoretically, if you're trading always in short, you'd sell below 66 or below 64. And the bulls, it's reasonable to get out below 66 or below 64, or use a really wide stop and scale in lower. However, today it turned out to be a terrible strategy if you did it. Bulls tried to get another reversal on 69, but again, could not get the bar to close on its high. And it's following 3 bear bars. So that's not going to attract a lot of buyers. You can take a chance. We should get up to the 64 high, but if you're taking it, you have to be really quick to make decisions. We have an II 69.70. So for the bears, it's a low one sell, but it's a decent bull bar 69 and a tail and a bear bar 70. And if we do go below 70, it would be possibly a third leg down and a wedge, 64 or 68. So that's not a great looking sell. I'm not willing to take that sell. The bulls might still buy above 69, even after seeing 70. We have an II, so it's a reasonable thing to do. Bear bar 70, not a lot of bulls bought above. Outside down 71, 72 closing near its low. It looks like we're trying to go lower, but it's a third leg down, 64, 68, and we're trying to go sideways here. So I think there will be fewer bears willing to sell. A lot of bears will wait or a couple legs sideways to up before looking to sell again. So not a good sell, not a good buy, usually means sideways. Bulls, a double bottom, high or low double bottom, 73, 68, but a doji bar after 3 bear bars, that's not going to attract a lot of buyers. We broke above the bull bar 69, but big tail on top, not good for the bulls. And then we have a reversal down 75. And I said I debated taking the short. I wish it was bar 74 and not 75, but it's a strong bear trend, bear bar closing near its low. And in hindsight, I should have taken the short. For the bears, it's a double top bear flag 69. The bulls tried twice to get a reversal, and they're failing twice. And therefore, a lot of bears will sell. My concern was the time of the day. I wished that it was a little bit sooner. And then we plunged down into the close below the 4,700 big round number. Really dramatic day. Climactic sell-off. Whenever there's a big sell climax like this, the next day we'll have profit taking 70% of the time. 70% of the time, there will be at least a couple hours of sideways to up trading that starts by the end of the second hour. Can this be a V bottom, straight down, straight up? Probably not. I mean, anything is possible. But we should get some kind of a reversal. This is too far, too fast, and a lot of the bears will take profits. They might start taking profits in the overnight session. And very strong bear breakout, and then a lot of tails and overlap. So we should get up to here, maybe up to here tomorrow, possibly in the overnight session. Stop order traders, as I said early on, not really good for stop order traders. You know, I think buying above 10 is okay, but I'd get out quickly. Selling below 19, probably okay. Double top bear flag 15. Buying above 21, okay, but disappointment. I would get out as 25 turned down or below 25. The II 29, okay, but again, disappointing rally. I'd get out a tick below a bear bar 37 or a point or two below a bull bar 36. Double top bear flag. Here, I would sell below the bear bar or below 38, below 42. It's reasonable to buy the climactic sell-off above 45, but you really needed to start getting bull bars closing near their highs, which did not happen. I would not buy above 48 or 50. And for the bears, reasonable to sell below 2 at the moving average 51, but 4 dojis probably not going very far. And if you did sell below 51, I'd get out above 53. FOMC announcement, huge outside down. You could sell below 55 or the close of 56 or below 56, but you have to trade small because the bars are huge. Still sell the close 57, 58. Can you buy above 59? I think it's better to wait for a bull bar closing near its high. But if you get out of shorts above 59, you have to sell again, either a new low below 59 or below 60 bear bar or below 61. Really climactic selling. So the probability is less that we're going to go down. However, at the times when it does go down, it can go down very far, and today is one of those times. So it's back to sell the close below 61. Below 63, I said that might be a third leg down, 58, 61, 63. So I said I would not sell below 63, a bigger bar and a possible parabolic wedge. Reasonable to buy above 64, higher probability. Wait to see if we get consecutive good bull bars. I would get out below 66, below 64, below 67. And for the bears, some bears would sell below 66, some would sell below 64, others would sell below 67. In here, nothing to buy. I would not sell. Well, you have an II 70. You know, I don't know. I think it's consecutive sell climaxes. I personally would not sell below that II. However, I would certainly consider selling below 75, but I really wish it was at least 1 bar earlier in the day. Limit order traders. The first couple of hours was all limit order trading. anything bearish, you buy. You buy the close of 1, you buy below 1, you buy the close of 7, the close of 13, 19, 20, 25, 27. And you sell anything bullish, and you sell with limit orders at the moving average, and you sell more higher. And then once we started to break to the downside, 48, probably sellers not far above. 50, probably sellers not far above. And then through here, it's so climactic, I don't want to sell the 59 high. And then here, would there be buyers below 65? There might be. I'd rather, if I bought above 64, which I did, and if I'm looking to buy more, I want to get another good bull bar, so I don't want to buy 65 or 64. Disappointed 66, so I typically would get out below 66. And here, in II 70, would I buy the 70 low? No. You might sell the 70 high. 73 high, it's, I don't know. I personally did not sell it, even though 4 bear bars. I thought we have a double bottom. We might break above 69, and we might get a short covering rally into the close. But chances are the short covering rally will come tomorrow. We may get some follow through selling, but chances are we're going to get a short covering rally, or at least a couple hours of sideways to up trading tomorrow that starts by the end of the second hour. So there might be some follow through selling in the first hour or two. Question, do you think it was okay to buy above 64 with a wide stop and buy more above 73 and stop out below 68? I think it's okay to buy above 64 and use a wide stop. But typically if I do that, I personally get out if there are consecutive bear bars closing on their lows, like 67. And then what I'll do is I'll wait for another bull bar, but I want a good bull bar, and I'll buy a double-sized position. So let's say you're trading one contract and you buy above 64, and you're looking for a bull bar closing near its high and buy more above, let's say, 69. Then you'd be long 2 contracts. The alternative is to get out below 67 and then buy 2 contracts above 69, or wait for a better buy signal bar. I would not buy above 73, 4 bear bars in a tight trading range. So I personally would not take that. And if I were still long, I would get out below 75 because it's a credible sell signal. What happens in strong bear trends? The stronger the bear trend, if you're looking to buy a short covering rally, the stronger the buy setup has to be. And strong bear trends are constantly forming buy setups. Most of them are bad, and the market keeps going lower. But if you have a sell climax with 2, 3, 4 legs down, and you start to get 1 or preferably 2 or 3 bull bars closing near its high, that's the kind of thing that traders will buy. The market in strong bear trends is always offering buy setups and buy signal bars that don't quite look good enough. And when it does, don't take them. So 70, the II, the high 2, 73, I never take those because they're usually bull traps trapping you into a bad long. Question about yesterday. For yesterday, buying above 43 and 47. 43 and 47. Okay, 43. You can argue parabolic wedge, 1, pullback 2, pullback 3, different ways to look at it. And a higher low double bottom, a higher low major trend reversal. Really good bull bar, similar to what we had today. But with all those bear bars, I typically will wait for a second buy or for consecutive big bull bars. And we did not get the consecutive big bull bars. And we had a second buy at 47, but you had fewer bulls buying it. It's a smaller body and a bigger tail. So had I bought above 47, I would have exited below 43, and I probably would look to go short, double top bear flag, 44, 48. So I would get out below 48 and look to go short. Okay, question 4. Yesterday, buying above 43 and 47, do we need a wide stop? 43 and 47. As I said, if you're buying in a strong bear trend, I think it's dangerous to use a really wide stop unless the market is clearly trying to reverse. And this is a lot of bear bars, so I don't want to take the first buy 43, and I do want to take a second buy 47, but it wasn't good enough, so I would not take 47. I would buy above 55, and I did. I did buy above 55 yesterday. A wedge, 1, 2, 3. Spike in channel, spike, pullback, channel. Usually the channel ends with a wedge, and usually you get a reversal up, and you try to get back to the start of the channel, which we did. Now, when you're scalping, do you use mainly a 2-minute chart or a 5-minute chart? And what EMA do you use for the 2-minute chart? When I'm scalping on a 2-minute chart, I'm using a 10-bar EMA. So here's a 10-bar EMA, and this is a 2-minute chart. And so if I were scalping this, every time it gets to the moving average and there's a bear bar closing near its low, I would sell below. So sell below, sell below, sell below, sell below. Maybe sell below there. This is getting more into a trading range. But here, start to sell below, sell below, sell below. And buys, that's far enough below the moving average. I might, in a good-looking bar, I might buy that for a scalp up to the moving average. What about this? A parabolic wedge, 1, pullback, 2, pullback, 3. I might buy that for a scalp. And am I using the 5-minute chart or 2-minute chart? When I'm scalping, sometimes on the days when I'm not in the room, I will scalp, especially if the market is not trending strongly. And I'll typically look at both the 2 and 5-minute charts. I prefer scalps on the 5-minute charts, but if the bars are small and if I think we're near a significant reversal, I'll often put up a 2-minute chart and look for an earlier entry. But in general, at this point in my life, I prefer, when I'm scalping, I prefer to scalp off the 5-minute chart and not the 2-minute chart. All right, tomorrow we should get a short covering rally for a couple of hours at least. It could be all day, but this is probably a spike in a channel. We're starting to get dojis. That usually means two-sided trading, so we should get up to here at a minimum, maybe up to here. But we may go lower first. There's a 30% chance that tomorrow will be a second consecutive very strong bear trend day, maybe 25% chance. So that means it's possible, but it's just not likely. So it's possible that we'll just keep doing this all day tomorrow. 75% chance, some big number. We're going to bounce and go sideways for at least a couple hours. All right. Hope everybody has a good night.